Visa or Mastercard, both these companies have been great spots to put in your portfolio for the last decade, and both are pretty massive. And you may use these companies every single day without you even realizing. Every time you do a transaction, whether you're out in a cafe, online shopping, or just purchasing anything, a small fee is collected that goes towards Mastercard or Visa. And there's a common misconception that they have offer credit. That's just what the banks do. So we're going to dig into if these businesses are worth adding to your portfolio, the difference between both of them, why they're incredible companies, how the fundamentals of each business, how they work, and why you should definitely consider investing in either one of them. And by the end, I'll tell what I'm invested in and why I am. But really, I don't think you can go wrong with either one of these companies. So let's go ahead and get started. So first, I just want to talk about how the business model works for both these companies. So when you use your card, the transaction goes through a series of steps. First, the merchant bank sends the transaction request to the card's payment network, Visa or Mastercard, and then the payment network communicates with the card issuing bank to check if the transaction should be approved. All of this happens in seconds, and Visa and Mastercard charges a fee for processing the transaction. These fees can be broken into two main categories: service fees, which are charged to banks based on the volume of transactions, and data processing fees, which are small fixed fees charged for each individual transaction. It's this steady stream of fees multiplied by billions of transactions worldwide that generate their immense revenue. What sets Visa and Mastercard apart from their competitors like American Express or Discover is their open loop system. Unlike American Express, which acts as both the network and the issuer, Visa and Mastercard partner with a wide range of banks and financial institutions to issue their branded cards. This allows them to scale globally without the need to handle the complexities of underwriting a customer directly. It's a model that relies heavily on volume. More cards in circulation and more transactions mean more fees. With billions of cards issued and trillions of dollars processed annually, Visa and Mastercard have built what is essentially a duopoly in the payment industry. They share about 80% of this market. And that's one of my investing philosophies of what I invest for is companies that have a moat or a dominant market space, companies where it'd be hard for competitors to entrench. And Visa and Mastercard, they definitely share a duopoly there, and they're both accelerating their growth year over year. So I just wanted to go over the difference between both of them. So first of all, valuation, you can see that Mastercard is at a forward PE ratio of 32, while Visa is at a forward PE ratio of 28. So Visa is a little bit cheaper right now, but just because Visa is cheaper doesn't necessarily make it the better pick. Now, if we look at their performance over the last 5 years, you can see that the green is Visa with an 83% return, while the green is Mastercard, and the yellow is Visa with 74%. So Mastercard has outperformed Visa just a little bit, but overall they're very, very, very similar, and you can't go wrong with either one. If we look at the last year, Mastercard has outperformed Visa just by a little bit, but not by much, 26% versus 21%. And you may be wondering some differences between these companies. And one difference I could point out is Mastercard has more of a share in the international market, while Visa has more dominance in US, the domestic market. So their business models are very identical at first glance, but there are key differences in how they operate and where they generate this revenue. They both have profit margins pretty high. For example, Mastercard's operating margin is 56%, while Visa's operating margin is 66%, which many businesses of this size and this valuation would kill for that. So it's a really good business model when it comes to their profit margins. But I want to go back to the US versus international thing. So Visa is heavily reliant on the US market, with a significant portion of its total payment volume coming from domestic transactions. Mastercard, on the other hand, has a stronger presence internationally, particularly in emerging markets. This distinction is important because it influences how each company is positioned to grow in the future. Mastercard exposure to international markets give it access to regions where cash is still prevalent, but rapidly being replaced by digital payments. Visa, meanwhile, benefits from the stability and maturity of the US economy, where card usage is already deeply entrenched. So I also want to talk about their high margins. Another thing that makes these companies stand out is their minimal infrastructure required to maintain their networks once they've established it. Decades ago, Visa and Mastercard invested heavily in building their global networks. Today, the cost to maintain these systems are relatively low compared to the revenue they gain. And we can just see this right here. On Visa, you can see that their earnings, their EBITDA is about 6 billion, and then their revenue is 8 billion. So if you do 8 billion minus 7 billion, they're not spending a lot of their revenue because they don't have to. It doesn't cost that much to maintain their system. And if we just look at both these companies annually on these charts, you can see both companies are their cards year over year. Mastercard's increasing their cards by 8% on average year over year for the last 10 years. While Visa, if you look at them, total Visa cards in the last 10 years, it's about 7%. So they're both growing heavily. Now, I do want to address one misconception about these companies, and that is banks versus Visa slash MasterCard. Banks are the ones who issue the credit. They're the ones who take on the risk of someone not paying back a loan or something. That's on the bank. MasterCard and Visa, all they simply do is just connect the merchant to the bank, and they take a small fee with them. And that's really it. It's a very simple business model. It's low risk, and there's a common misconception that, they get a look because they're credit cards, but at the same time, it's really the banks that are causing the high debt through credit card debt, not these companies. They're just connecting the merchant to the seller or to the buyer. And you can see that in Visa's cards, the majority of their cards are actually Visa debit cards, which is growing on average of like about 7 a year, while their credit are growing a little bit, definitely a lot slower. In the last 5 years, only about 2%, which may be from competitors like American Express or Discover. But like I said, their business models are a little bit different because they're not open loop. They're the issuer themselves, and it's kind of like in one system. Visa and MasterCard just partner with the banks, so it's a more of efficient business model, and it's why these companies are both up, and they've outperformed the market really year over year for the last 10 years, and I expect them to continue to do that because if we just look at their free cash flow, it's growing on average. Visa's growing about 10% every year for the last 10 years, while MasterCard is growing at about 11 to close to 12% year over year for the last 10 years. So their ability to generate consistent cash flow is a strength. Both companies use cash to reward shareholders through dividends and share buybacks. Visa has increased its dividend for 15 consecutive years, while MasterCard has done it for 16 years. And if you have a small portfolio, you're young like me, you may not see the power of compounding, but if a company is going to increase their dividend year over year for the next, several years to come, that's how you can build a snowball effect of passive income through dividends. It's not through investing in these high yields right now. You want growth in the dividend, and you want the dividend to grow year over year and compound year over year, so you get more cash the older you are. It's just, if you wait patiently and you build that stream, your value is going to go up over time. So if we look at MasterCard right here, they've been growing on average almost 20% over the last 10 years. So if they have a small yield right now, but if they keep that up, your yield on costs in the future when you're still investing in them is going to be so good if they continue to grow that. And it's companies like this, if you have a long time horizon, that are more attractive than companies like Coca-Cola or 3M that pay a dividend, but their growth is slowing down. If we look at Visa, we can see that their dividend in the last 10 years is growing 17%. Just a little shorter, but still really good on Visa. And both companies are buying back their shares, which when a company buys back their shares, it just makes your shares more valuable. So just another growth aspect that's really good over the long term. They also have balance sheets for the companies they are. They definitely sure they don't go in too much debt, which is good. Now, the shift to a cashless world, but beyond the numbers, what I definitely want to talk about how the world's becoming more cashless, right? As the shift away from physical cash accelerates, these companies are positioned at the center of a global trend that shows no signs of slowing down. Whether it's online shopping, tap-to-pay technology, or even cross-border remittance, their networks power the transaction that keep the global economy moving. This dominance doesn't just make them profitable, it makes them essential. And it's why they're able to grow their earnings per share year over year too, and really beat estimates. So it's definitely a good company to hold over the long run, and I really don't think you can go wrong with either one. So now that we've covered how these companies operate and what makes their business model so powerful, let's dive deeper into their financials and strategies to see how they stack up against each other. When comparing Visa and Mastercard, their financial paint a picture of two incredibly successful businesses with slight but meaningful differences. Let's start with revenue. Visa is the larger of the two, generating $35.9 billion in the trailing 12-month revenue to Mastercard's, about 27 billion. This makes Visa the dominant player by share scale, but bigger doesn't always mean better. Mastercard's smaller size comes with a key advantage: higher growth potential. Over the past few years, Mastercard has posted faster revenue and earnings growth compared to Visa, thanks in part to its stronger international presence. Speaking of international markets, this is one of the clearest ways the two companies differ. As mentioned earlier, Visa holds a larger portion of its revenue from the United States, where it processes significantly more payment volume domestically than Mastercard. In fact, Visa's US payment volume in the most recent quarter was $1.5 trillion. That's with a T, compared to Mastercard's $652 billion. However, Mastercard compensates for this with much stronger performance outside the US, where it possesses $1.2 trillion compared to Mastercard's near $1 trillion. So they both have a lot of volume. And even though it's a small fee that they take, because of how much volume it is, it just goes to show how much revenue they're able to pull in. And as people spend more and more and more over time, as they online shop, as they use these cards, the more these businesses are just going to grow in the long run. Which is why I want to talk about profit margins, which is a key metric to understanding a company's efficiency. As mentioned earlier, Visa operates at a higher margin compared to Mastercard. That's just because I think Mastercard likes to do a little bit more research, more innovative stuff than Visa. That said, Mastercard's margins are still stellar and well above most companies and other industries. These high margins are a result of minimal costs associated with maintaining their networks once they're built, as discussed earlier. Both companies generate good free cash flow, which in return, they buy back shares, increase the dividends. Already mentioned that. But I just wanted to talk about how these companies are just going up year over year. It's really not that hard to understand. People are just spending more and are spending it less on cash and more on cards, right? So as the world shifts more cashless, these companies just capture more from that small fee, which makes them a dominant force, and which is why they're a duopoly, and they're going to continue to go up, in my opinion. But MasterCard, as mentioned, they have more of an international presence, may have more room to grow. But the US, in my opinion, is growing just as fast. But I want to talk about their partnerships. For example, partnerships with fintech companies, and its focus on payment solutions such as Mastercard, Send, and cross-border services position it well for future growth and emerging technologies. Both companies stand to benefit from ongoing shift to digital payments, but Mastercard's slightly more innovative approach gives it an edge in certain areas. For instance, Mastercard has invested heavily in cybersecurity and AI-powered fraud detection, which not only protects its network, but also builds trust with consumers and businesses. Visa has also made strides in this area, but tends to take a more cautious approach to innovation, focusing on scaling its existing operations rather than pushing into new territories. Lastly, we can't overlook the risk of these companies. Both of them do have a little bit of government regulation overseeing. The governments worldwide are paying closer attention to the fees merchants pay for card transactions, which could pressure margins over time. Additionally, competitors from digital payment platforms like PayPal are emerging blockchain technologies could pose long-term threats, although it has yet managed to disrupt Visa and Mastercard's dominance. And I'm personally not too concerned about it because, as mentioned earlier, they have about 80% market share in their respective fields, and I don't think it's gonna disrupt sheer volume Mastercard and Visa undergo every day. Both companies, I mean, they're both great companies. Yeah, the dividend yield to them 0.5% for and 0.7% for Visa, but because they're growing their dividend year after year, it's only going to take a few years for your yield on cost to probably go above 2% if they continue to grow. And not only are you getting the dividend in like 20 years, you're going to get a big dividend, but you don't sell it and your shares are going to appreciate over time too. So it's companies like these I like investing in. Now, you may be wondering which one I'm invested in, and the answer to that is MasterCard. You probably could tell just by the tone of this video, maybe a little biased, but I just think MasterCard, they're growing at a faster pace than Visa is. Both are growing very similar. And if you look at this chart, you see when one goes down, the other goes down, and when one goes up, the other goes up. So I think if someone owns Visa, it's definitely not a wrong decision. But I do think MasterCard is definitely a company worth researching and adding to your portfolio because they just have all the fundamentals and what I personally look for in a company, especially with a company with a moat. They're a duopoly, right? And their fundamentals are very strong. They have easy to understand business models, and they're going to continue to grow and scale year over year as people are going to start spending more. So I want to know down in the comments if you're invested in any one of these companies, why you chose to invest in them, other companies you may hold. I know Warren Buffett likes investing in American Express, but as mentioned earlier, American Express is a little bit of a different business model than Visa or MasterCard. It's a little bit more complicated and there's a little bit more risk with American Express because they don't have a huge partnership with the banks like MasterCard and Visa do. So I want to know what financials you're invested in. Personally, MasterCard, I think MasterCard is the only financial I'm invested in right now out of the 19 companies I do hold, but I do continue to hold them and probably add more to them. They don't, their stock isn't as volatile, but it just slowly every year. And as you can see in this chart, I mean, it's just slowly been going up year over year. And they have massive dips like some other companies we'll see like Amazon or Google. So they're definitely a safe play. I think they're reliable and I think it's a safe company to invest in. So I want to know what you're invested in. If you found this video informative, please hit the like button, subscribe, comment, interact with this as I'm a small YouTuber. So it's going to mean a lot if you do that so you can push my video out. And I'll see you in the next one. Thank you.